So, picture this. A government gives a company a huge check, millions of dollars. How does that actually show up on their books? Is it just instant profit, a free gift? Well, the answer is a lot more interesting, and it's all governed by a crucial set of rules called IAS 20. This standard tells us exactly how to handle government grants. Let's dive in.
All right, let's kick things off with the big puzzle that IAS 20 was really created to solve. When the government just gives a company a massive chunk of cash, what is it? From an accounting point of view, I mean. Because, getting this wrong can seriously mislead investors.
So let's put you in the driver's seat. Imagine your company gets a $10 million check from the government to build a brand new eco-friendly factory. What do? Do you just book that as $10 million in pure profit for the year? I mean, that feels a little too easy, right? Or maybe it's some kind of weird loan that you don't have to pay back. See, without clear rules, companies could spin this in all sorts of different ways. And that's exactly why we need a standard like this.
Okay, so before we can even think about the accounting, we have to get the definition right. What exactly counts as a government grant under these rules?
And here it is. Now, the key phrase here, the absolute heart of this definition, is compliance with certain conditions. This is everything. It tells us right away that this isn't just free money. Nope. The government is giving this aid because it expects the company to do something specific in return. And that little detail, that conditionality, it changes the whole game.
So, the standard breaks grants down into two main types. The first one is pretty straightforward, grants related to assets. You can think back to our eco-friendly factory example. The government gives you money, and the number one condition is that you have to use it to build or buy a long-term asset. Simple as that.
And the second category? Well, that's grants related to income, which is basically the catch-all for everything else. So think of grants to help cover R&D costs, or maybe to subsidize employee wages in a certain area. These are tied to your day-to-day operating expenses, not those big physical assets we just talked about.
It's also super important to know what isn't covered by IAS 20. For example, if the government builds a brand new highway near your factory, sure, that's a benefit to you, but it's indirect. It's not a grant under these rules. The same goes for things like tax holidays, or if the government decides to buy shares in your company. Those situations are all handled by completely different accounting rules.
Okay, now we get to the really juicy part, the heart of the matter. Once you actually have a grant, there were historically two very different schools of thought on how you should put it on the books. This was a real debate.
And this slide just lays out the two sides perfectly. On one side, you've got the capital approach. The folks in this camp would say, hey, a grant is basically a financing tool, kind of like an owner putting more cash into the business. It's not earned revenue, so it should completely bypass the income statement and go straight to equity. But then, on the other side, you have the income approach. And they argue the complete opposite. They say, no. These grants are earned by meeting conditions, and because of that, they have to be recognized as income to match the costs the company takes on to earn them.
So, which side won? Who did the standard setters agree with? Well, they made a very, very clear choice, and it was based on one of the most fundamental principles in all of accounting.
And the winner is the income approach. That's right. IAS 20 decisively rejects the idea of treating these grants as a simple injection of capital. Instead, it sees them as something that has to be matched up against the activities they're meant to support.
This quote right here, straight from the standard, is the golden rule. The key takeaway is this. You recognize the income from the grant at the same time you recognize the expenses the grant is supposed to cover. This is the famous matching principle in action. You match the income with the related expense. It's that simple and that powerful. Here's a really great way to think about it. It's like a business scholarship. If you get a 4-year scholarship for college, you don't count all that money as income in your first week, right? Of course not. You recognize it over the 4 years as you actually pay for tuition and books. A government grant works pretty much the exact same way. That income gets spread out to perfectly match the costs. Okay, so we've got the theory down. Match income with expenses. But what does this actually look like on a company's financial statements? Let's dig into the two ways this can be presented specifically for those asset-related grants.
So IAS 20 actually gives companies two options here. Method 1 is to record the grant as deferred income. Now, that's basically a liability on your balance sheet, meaning it's money you've received but haven't earned yet. Then, each year as you record depreciation on the new asset, you move a little piece of that deferred income over to the income statement to offset the expense. Pretty clever. Now, method 2 is a bit more direct. You just subtract the grant right from the asset's original cost. This makes the asset's value on the books lower, which naturally means you have less depreciation expense each year. See? In the end, both methods achieve the exact same goal. They match the grant's benefit to the asset's cost over its entire life. Of course, things don't always go according to plan. What happens if a company actually fails to meet the conditions tied to the grant? And how do investors like us find out about all of this fine print?
And this is a really critical question. Remember, these grants are conditional. It's not a free-for-all. If you promise the government you're going to create 100 jobs with that new factory and you only end up creating 50, well, they might just want their money back.
So, if a grant has to be repaid, you basically have to undo everything you did. You reverse the initial entry, either by adding the grant amount back to the asset's value or by wiping out whatever's left of that deferred income balance. But here's the really crucial part. Because you've been recording less depreciation expense all this time, you now have to play catch-up. You have to calculate all the depreciation you would have taken without the grant, and then you book that entire difference as one big expense right now. Ouch. It can be a pretty painful hit to that year's profits.
And finally, let's talk about transparency, because it is absolutely essential. Companies can't just quietly take government money and say nothing. They have to disclose their accounting policy. Did they use the deferred income method or the deduction method? They have to give details on the nature and extent of the grants they've recognized, and, maybe most importantly, they have to disclose any conditions they still have to meet. This is what allows investors to see the potential risks hiding in the footnotes, like the possibility of a future repayment.
So, the next time you see a headline screaming about a company getting a massive government subsidy, you'll know the real story, won't you? It's not just a simple cash windfall that boosts one year's profits. Nope. It's a carefully managed flow of income, systematically matched against expenses over time, all dictated by the clear, logical rules of IAS 20. Now you know how to look past the headline number and understand how it really hits their bottom line.